Welcome to the European Real Estate Association's discussion on UK REIT dividend champions. EPRA represents and promotes the REIT sector across Europe. My name is Matthew Fletcher. We would say that it's important to have REITs in your investment or retirement portfolio so you can diversify away from your own property if you have one, and also to provide income for your life expenses and your retirement. Importantly, your property does not usually provide income. A REIT owns and manages a portfolio of real estate and pays out 90% of its post-tax earnings to shareholders. You may well have seen our recent graph that demonstrates a 63% return over the last 10 years due to dividend reinvestment from a basket of UK REITs that deliver over a 5% dividend yield. That particular return is crucial to your investment portfolio. I'm delighted to have today 3 CEOs that are truly CEOs of UK REIT dividend champions. I'll introduce them in alphabetic order of company. First of all, to my right, I have Allan Lockhart, the CEO of NewRiver REIT, a £250 million free float market cap and a £720 million enterprise value business that invests in core shopping centres and retail parks. Mark Davies, CEO of Primary Health Properties, a £2.3 billion free float market cap and £2.6 billion enterprise value business that invests in modern, local primary health care. And Rob Abram, CEO of Supermarket Income REIT, a £1 billion free float market cap and £1.6 billion enterprise value business that invests wholly in supermarket property. Gentlemen, welcome and thank you for attending today. It'd be great if we could talk to the first point of the overall company and your strategy that helps to drive the dividend income. It'd be great if you could start, Allan.
Well, thank you very much. And as you mentioned, we're a specialist REIT. We invest in UK shopping centres and UK retail parks. Today, we have a portfolio on our balance sheet of over 800 million of assets. We're invested in pretty much every region in the UK, but we're also managing assets on behalf of investment partners. Together with our balance sheet assets, that totals around 2.4 billion. We're collecting 225 million of rent per annum from around 3,500 tenants. And it really allows us to have incredible insight and access to data around what consumers are doing every day in terms of their shopping. We're a business that is very focused around income and income returns. We're strong believers that in the long run, income returns are the major driver of a total return. And as a business, we are being very focused around delivering very stable income, trying to grow our income, and therefore delivering very attractive dividends for our shareholders.
Thanks, Allan. That's great. And Mark, over to you, Primary Health Properties. Perhaps explain the company a little bit and the strategy to drive that income.
Thanks, Matt. Thanks for having me. Thanks, everybody. I'm Mark Davies, CEO of Primary Health Properties. We're a FTSE 250 healthcare REIT. We have a track record of investing in healthcare property in both UK and Ireland now for 30 years. And for 29 of the last consecutive years, we've managed to increase our dividend every single year during that period. We own and manage a portfolio of about 6 billion of assets in the UK and in Ireland. Our story is one of secure income. Roughly 90% currently of our income is state-backed, i.e. the rent roll is paid by the UK and Irish government. But also a story of long income. Typically when we're entering into asset management and development activities, our tenant, our occupier, is seeking a long-term lease. We have a great track record. We've just completed a transaction with Assura, which has increased the scale of the business, the market cap and liquidity. And hopefully I'll get a chance to say a bit more about that a little later. And just to finish, if I may, the sector that we're in is one that has structural growth. We have a growing population, an aging population, and an NHS that's being reformed by moving patients into primary and community health from hospitals. because that will save the government money.
Thank you, Mark. Rob, Supermarket Income REIT.
Thank you. So Supermarket Income REIT, or Super, is ultimately a landlord to big supermarkets. So the portfolio that we manage is about £1.9 billion today. And our aim is to provide a very secure, defensive dividend income to our investors from the rents that our tenants pay. At the current share price, that's a yield of about 7.5% which is ultimately backed by grocery income. In terms of the strategy, we target top performing food stores. They've often been food stores sites for 30 or 40 plus years. Weekly sales often exceed £1 million a week for the operators. So these are truly mission critical assets to our tenants. Within that, we primarily target omnichannel stores. So these perform traditional in-store shopping as well as online home delivery and click and collect. And the portfolio itself, 75% or so of our income is Tesco's and Sainsbury's, so the UK's leading and largest operators. Our average lease length is 11 years, and around 80% of our leases are inflation linked. So that just provides us with a very visible growing income stream over that 11-year lease period. And coming back to the earlier point, therefore, we provide that very secure and predictable dividend income.
Very clear, thank you. Mark, moving on to a particular aspect that we'd like to pick up on for the general audience. Could you please just talk to the idea of your business as an operational business, rather than what people may consider as traditional real estate, which is almost a collector of rent?
Yeah, I think when I think about the portfolio that we own and manage, I very much do think about that as an operational real estate portfolio. We have a team of experts. We have a knowledge in the sector that we're in that enables us to manage these assets very, very well. On our track record, whether you're looking at total property return, shareholder return, obviously dividend is very, very, very compelling. And we're obviously working with a very important stakeholder in the UK government and the Irish government, who put healthcare, right at the centre of their strategy, and therefore the team, by definition, is very hands-on and therefore very operational, given that we are ultimately owning, managing, sometimes developing critical social infrastructure assets. So that requires a certain approach and a dedicated one, and we have a team of experts that do that day in, day out very, very well.
That's great, thank you. And taking a kind of macro view of the world right now, Allan, are you able to just talk briefly to inflation, given the environment we're in the UK, and how that impacts the business, but also can be a positive influencer as well?
Well, I think, inflation, if it's sustained at a high level over a prolonged period of time, is definitely not a good thing. The good thing is that inflation has been moderating, and the markets are expecting inflation to come down, next year. What we've seen in our marketplace is that consumers have been able to cope with higher levels of inflation, and that's partly reflective that, for a while now we've had wage growth exceeding inflation. So that is usually positive for rising living standards. Unemployment levels are still pretty low from an historical perspective. There are elevated job vacancies, and consumers are sitting on a lot of excess savings. So that has broadly been supportive around spending in the shops. For retailers, a higher inflation environment is impacting in different ways. Certainly for the food retailers, they have been facing increased costs, increased employment costs as a result of the increase in living wage and national insurance, and they have been passing those costs on to consumers with higher prices for food products within the stores. For non-food retailers, it's a different story, because a lot of those retailers are sourcing their products from the Far East. We've seen energy costs come down, we've seen shipping container costs come down, and we've seen the US dollar depreciate against sterling. Most international trade is transacted or priced in US dollars, and as the US dollar has depreciated this year, it means that the import prices for non-food retailers have been coming down. So that, to some extent, has been deflationary. And then, of course, with the tariffs, particularly between China and the US, has created some excess capacity in the supply chain. And I know from our relationships with some of the key non-food retailers, they're being able to access some amazing deals out of the Far East. So non-food has been, quite positive in terms of being able to mitigate some inflationary pressures. And then when it comes to the sort of capital markets, I think the key point here is that clearly with high inflation is resulting in the Bank of England having to do something about it. And that's why interest rates are quite elevated. And of course, that has implications for the UK government because the government is in a fiscal tight position, carrying a lot of debt, and therefore the cost of borrowing for the UK government has been increasing, which is putting pressure, on the budget. And we'll see the results of that, I'm sure, later on next month. But the reality is that the cost of borrowing for everyone has been increasing, whether you're somebody that has a mortgage or you're a business that's looking to invest or you're the UK government, the cost of borrowing has increased, and that's having, an implications. So really, really hopeful that the UK government and the Chancellor will be standing up on the 26th of November and presenting a very decisive budget that the bond markets are going to like, and we hopefully start to see bond yields come down. And I think that'll be hugely beneficial for consumers, businesses, and the UK government. So let's hope the Chancellor makes the right decisions.
Thanks, Alan. It's true that, and what we wanted to bring out was that more nuanced view of the inflationary environment. And when you look at it on a more global level, you do see a far different picture to what's really presented in the UK press as the dumbing down and the dangers of the inflationary environment. Rob, talking about the kind of macro environment that we're in, could you perhaps talk about interest rates, perhaps relating it to the financing of the business, but also how it impacts on the underlying client agreements as well?
Yeah, absolutely. So look, like all borrowers, the rise in interest rates we saw pretty rapidly 2022 onwards, we've had to adjust. So you do have an element of protection against that through hedging fixed rate debt instruments. But as those mature, then you do see a step up in the debt costs. Now, what I'd say is we've actually adjusted to that now. I think we've had to work hard in terms of reducing costs elsewhere in the business, and we've taken out a significant amount of the cost base that allows us to operate in that higher cost of debt environment. We recently issued a bond at just over 5%, and in that environment we can continue to operate. So we've adjusted. It clearly has an impact on equity market valuations and sentiment towards real estate as a whole. But you mentioned the underlying contracts. Well, actually 80% of our leases are inflation linked, so that provides an element or a degree of protection. But also fundamentally, and Alan's just mentioned this, of food price inflation. The grocery is non-discretionary. Unfortunately for all of us as consumers, it means that you have to pay more in terms of products on the shelves, but ultimately the operators are able to pass through that inflation and the higher cost. So it does give an element of protection for us as a landlord, in that our tenants are seeing their store revenues grow in line with inflation. That is growing in line with our rental uplifts on the underlying portfolio. So the two move in step. So it means that the growth that we're seeing in the top line is sustainable, and that helps us support the dividend longer term.
That's great. Thank you, Rob. Mark, turning to another subject that I'd like to raise in terms of scale and the importance and the impact of scale. Could you talk to the kind of size of the operation and the benefit that the scale has, and to the extent you can, anything about the recent company changes?
Yeah, very good question. I think probably one of the biggest shifts that we've all seen as CEOs of listed property REITs, particularly in the last 5 years, is the importance of scale and the economies of scale that can be achieved in the capital markets. So when we're looking at the debt market, we know that if we are bigger, we can borrow cheaper, all things being equal, because there's a wider pool of investors and bank margins tend to come down. So that's a very attractive proposition. I think we've just seen more and more demand for, therefore, consolidation and therefore for larger, more liquid listed REITs. And if you're able to achieve all of that, of course, a success breeds success, and then you get access to a wider investor base, which has, benefits. So I think scale is very, very important in capital markets. It's probably been as important as I can remember in the last sort of, 15, 20 years. Looking through the eyes of a shareholder, it's one of the consistent themes that we hear. And it was no doubt, one of the key strategic and financial benefits to the merger that we've just completed with Assura, which has enabled the business to double in size. We'll talk about cost ratios, I'm sure, as the presentation evolves. But again, cost ratios are very important through the eyes of a shareholder, and by being bigger and have more scale, you have the ability to be more efficient. We've proven that, and the transaction that we've just completed, we've told the market we can deliver economies of scale, integration benefits, and synergies. So, we're looking forward to be able to do that and say more to the market in the future.
Thanks, Mark. And Rob, could you talk about the impact and scale for Supermarket Income REIT and perhaps the different ways of achieving scale?
Yeah, absolutely. So look, out of the three of us here today, we have the least operationally intensive management business. All of our leases are triple net. The supermarket tenants themselves have responsibility under the full repairing and insuring leases for the ongoing maintenance and management of the properties day to day. So that means with a portfolio pushing on towards £2 billion, we can manage that with less than 20 people. And each time we add more assets to the business, there is very little additional cost of doing that. So it becomes very efficient to grow. As a result, relative to our scale, our target EPRA cost ratio for this year is below 9%, which puts us firmly among the sector leaders. So as I said, relative to scale, that's very efficient. In terms of our ability to drive further economies, we recently did a joint venture, and again, that you really start to see the benefits of that operational leverage coming through. We get paid a management fee by our joint venture partner for managing assets that were already within our portfolio. So it's just a really efficient way for us to continue to scale the business.
Brilliant, thanks, Rob. So as you can see, as a shareholder across different UK REITs and dividend champions, you get access to different real estate return and different types of income across real estate sectors. And that's really key in driving ultimate real estate return. EPRA talks about efficiency. And when we talk about efficiency, that has several different nuances to it. And an efficient investment is an ability to invest across different real estate sectors. And you won't easily get access to a lot of these sectors in your real estate portfolio without investing through listed real estate. Hard to invest sectors like supermarkets and retail parks and primary health are not easy to achieve in your own and without the expert management that we have in front of us today. That expert management comes at a relatively low cost as well, and that's a key part of what we consider to be an efficient way of investing. Added to that as well, you have a specific price, so as an investor, you know when you're going in and when you can exit your investment. That cost of investment is relatively cheap as well, so again, an additional point towards the efficiency. Allan, just looking ahead, why would you say is a good time right now to become a NewRiver REIT shareholder?
Well, we're in retail, and I know from our own shoppers love a bargain, and there's probably not a bigger bargain in the market compared to sort of NewRiver. Our share price today, 71p, versus our last reported net asset value per share of around 102p. You'll have an earnings yield that is double digit and a dividend yield of around sort of 10%, underpinned by a very well diversified rental cash flow, low concentration in our tenants, and a portfolio that is humming really nicely. We have an occupancy in the high 90s. In fact, in the last 4 years, we've not had an occupancy less than 94%. We have an incredibly high tenant retention rate when it comes to lease expiry or break. Again, that's well into the 90s. And we've now had four financial years of really strong leasing performance. And I think that's just sort of reflective of, firstly, the consumer has been way more resilient than financial markets had anticipated. Secondly, I would say our occupational market is in the best position for about a decade. And thirdly, the capital markets are really now starting to focus on retail real estate as being a really attractive asset class. So we're starting to see that liquidity flow through into retail parks, but also into UK shopping centres. So now's a great time.
Thanks, Allan. I think it's interesting that now is a good time in the real estate world, and we may be sidelined a little bit by fears about the UK economy. We may be a little bit sidelined about potential budgetary impacts, but actually when you look at the real estate cycle, there's an opportunity there which is probably once in a cycle, once in every a decade or so, or even longer in many ways. Mark, are you able to talk to the same question really? Why is now a good time to think about being a primary health properties shareholder?
Absolutely. And first of all, I thought it was a great response from Alan, so that's going to take some beating. Look, I think it's a fantastic time to invest in my company, Primary Health Properties. We're in a sector where we have structural growth, we have political tailwinds as well as demographic tailwinds. We've done a very strategic and importantly a very financially beneficial transaction by merging with Assura. The upside and the financial benefits of that transaction are not reflected in today's share price. So I think timing wise, I couldn't imagine a better time to own our company than now. I mentioned earlier on we have a 29-year track record of growing our dividend. I'm confident we can do that for 30 years and beyond with a £6 billion platform that sits behind the business and the team that we have. At the current share price, we're yielding 7.5% for a secure long income story. That's definitely a bargain. So I would certainly point that out to the audience who are with us today. And the capital markets have supported us in a competitive, bid situation against US private equity. So there's clearly strong belief in the story and the future. It's our job to now deliver on that belief because we're confident that we can do that. And we think that the returns are not just secure, but they are extremely attractive for any new investor coming into PHP today. So that's why I think you should invest.
Thanks, Mark. And Rob, Supermarket Income REIT. What's the why is now a good time?
Yeah, not the question you want to go last for, I don't think, after these two. But so look, I think for us, we operate in grocery, so it's ultimately a very defensive asset class. It's non-discretionary spend, so even through the periods of high inflation, we continue to see really strong sales growth at the stores that we own. So that just supports the income that we receive from the tenants and therefore supports the dividend that we can pay. We are Tesco's largest landlord. That sector specialism and the scale we have really does allow us to ultimately drive the best returns for shareholders through managing the portfolio. And if you take a step back and look at the bigger picture, you are seeing companies like ours that are still valued at or still trading on the markets at a discount to the underlying net asset value. These are companies that historically traded at a premium. So we look cheap ultimately at those kind of levels. In my mind, 7.5% dividend yield should look attractive. You only need to look at the amount of M&A in the sector and some very smart buyers in whether it's Blackstone, KKR, Starwood, those kind of names. There's some really smart money seeing great value in listed real estate companies in the UK. So I think that ultimately highlights the value that is on the table. And you've mentioned it's a cyclical business. It feels like we're very much at the bottom of the cycle now.
Thanks, Rob. This will be a question to each of you, and it's really more about the it's a real estate question. So it's about the like-for-like rental growth, because it's considered to be the real driver of dividends and the real driver of dividend growth. So, Alan, are you able to talk to the like-for-like rental growth potential at NewRiver REIT?
Well, you're quite right to identify the importance of like-for-like rental income growth, because that is really critical in terms of delivering, future performance. And as a business, we are super focused around delivering that. But I think in retail, and everybody knows that retail has had to go through some major challenges, and as a sector that's been, disrupted by technology, particularly around online retailing. But today, we feel that the sector is in a great position. Within our own portfolio, the very high occupancy, the tenant retention rate, and the very strong underlying consumer spending that we're seeing in our portfolio gives us great confidence around our ability to deliver that sort of consistent net rental income growth over the next sort of 5 years. And with net rental income growth, valuations should follow. And as hopefully our portfolio values start to increase, our LTV comes down, and it creates capacity for us to access some of our cash and liquidity to be deploying into the market to acquire assets and deliver even further earnings growth. So critically important, super focused on it. And I would say today, looking ahead for retail real estate, and in particular our own portfolio, the prospects are the most encouraging they've been for, I would say, 10 years now.
And Rob, like-for-like rental growth?
Yeah, so our portfolio, as I've mentioned, 80% or so is inflation linked. So we get that highly contracted growth, but that's also underpinned by the ultimately food price inflation at the sales level in the stores that we own. So it's absolutely sustainable growth, very visible and highly contracted. So that like-for-like growth coming through grows the top line. That again will support that dividend growth, given cost of debt is ultimately fixed. The cost of our asset, but the cost of the operations is relatively low and highly efficient. So we see really good visibility over that rental growth coming through. Our average cap on our inflation linked uplifts is 4%. Average floor is just under 1%. So you're able to see how that growth comes through between those levels.
Thanks, Rob. Mark, it might be slightly different in Primary Health Properties case, but the like-for-like rental growth and the look forward, could you speak to that briefly, please?
Absolutely, yeah. This is a very easy one for me to respond to, because we've already told the market what our expectations are about future rental growth. Because it's a story of secure income and long income, we're able to provide that guidance with confidence. When we presented to the market on the 24th of July, we had a capital markets day during the transaction that we were doing with Assura. We told the market that we expected to achieve like-for-like rental growth of 3% in the future. And clearly that is something that we said through verification with confidence, looking at analyst consensus around the company and the future projections of the enlarged business. That's very much in line with the company's own projections. But of course, because we've now acquired Assura and we're able to be more efficient, our cost ratio is coming down. At the last reported date, our cost ratio was 9.9%. We've also always had one of the lowest cost ratios in the sector. That cost ratio is clearly coming down. So our rental growth projections are 3% from here onwards, but our earnings projections are in excess of that, because we're going to be more efficient. Our cost ratios are coming down. Our earnings can increase as a consequence of that as a REIT. Investors can expect that to reflect nicely in the enhancement and the acceleration of future dividend growth.
Thank you, Mark. You've led me into another area that I actually wanted to explore as well, which is great. Earnings as a metric to look at valuation of a company, and really for the audience to understand that net asset value is one of the metrics that you can use to look at real estate, but it's not really the main driver or the real only way you should be thinking about business. Earnings is increasingly important, and we know from discussions at institutions and with specialist investors, EPRA earnings and the earnings focus is becoming more and more relevant in businesses. Are you able to just have Rob, a quick word about earnings as a useful metric alongside NAV?
Yeah, absolutely. And look, I think for us, it's both quantity of earnings as well as quality. So um, our earnings are very clean pass through, as I mentioned, through the triple net leases. So we have 100% occupancy. So there's no vacancy costs in our business. We have no capex because the tenants undertake all of the improvements to the properties. And we also don't really have rent-free periods in our space. So the cash, the earnings we report is ultimately our cash earnings, and that means our dividend is very well covered by that. So the quality of earnings is very high. When we then look to dividend, it's all about the sustainability of that. So yes, 7.5% dividend yield today, but as an investor, you want to know that that is sustainable. And for us, then that's about looking forward and saying, right, if all of our debt refinances at the current market rate of interest, can you continue to afford that dividend? And we absolutely can. We're continuing to demonstrate that to the market. We have some capital to deploy from today, but we're able to deploy that at levels which are, say, acquisition yields of 6.5% versus that incremental cost of debt of closer to 5%. You can see how that's a very clean pass through straight through to earnings with those triple net leases. And that's really should be the focus is dividend yield is one thing, but also dividend cover and the ability to sustain that dividend into the long term.
Thanks, Rob. And Alan, earnings, cash flow, NAV. Could you comment on that?
Well, I think cash flow is everything. Cash is cash. NAV, at the end of the day, is a subjective assessment around the valuation of a property, and that is more of a sort of art rather than a necessarily a sort of like a real result. So for us, like we tend to focus really on the earnings, because that's that is real, and valuing companies linked to their earnings, we think, is definitely the right way forward.
And we're definitely hearing more and more that NAV is one of the metrics, but the earnings is coming to the fore in many ways. Mark, do you have comment in relation to primary health properties?
Share the views of my colleagues. For me, it's all about earnings, and more importantly, it's all about cash. If you look at the healthcare REITs, in fact, look at all the REITs in the US, they're all valued off, FFO, i.e., a cash flow metric in your world, EPRA earnings. And I think that should be recognized. I think partly because of history and legacy and REITs being created in 2007, I still think we're hanging on a bit to NAV as a metric. I mean, we actually screen very well when you look at our NAV performance, but we're an income focused business. We want to continue growing our dividend, and ultimately its cash flow and earnings are the most important metrics when we make key decisions about the management of the portfolio, the business, and capital allocation. Again, in our sector, if you're looking at the importance of cash flow, which we strongly believe in, we don't have any rent-free periods. There are no capital contributions or tenant incentives. We're very efficient. So where we are able to invest capex, we get a very good return on that. And we wish we could do more. And we think with a receptive stakeholder in the UK and Irish government, we think that can be achieved. But if there's one thing I think we would all absolutely endorse and get behind, is the market looking at UK REITs far more through the lens of cash flow and earnings, and maybe move away from the NAV model that we all kind of grew up with, really.
It's interesting that there's a changing approach to the valuation of real estate, and it feels like it's a historical a construct that we always referred to NAV, and now, as there's a history of REITs in play over 2007 in the UK, but arguably the 60s in the US, you're seeing that that change and that almost different focus come through. So we're really seeing some important change, and that's what we would try and suggest to people that are looking at real estate, is that there are several metrics out there that are important within a basket of ways to look at businesses, but your UK dividend champions are looking at earnings alongside NAV, and that's the way that the future way of viewing real estate appears to be. I mean, I think as we kind of lead towards the end of our discussion, and it's probably best for us to consider the future prospects of the businesses and what shareholders should expect broadly from your business looking forward. Allan, are you able to talk briefly about that?
Well, we're really focused and determined to really grow the business. We think as a business, we're capable of growth and managing a larger portfolio. We definitely want to provide scale and better liquidity for our shareholders, but providing scale in the right way that creates value. And so, we feel confident we will have the ability to really double the size of the business over the next sort of 2 years. Last year, we made a big move, not dissimilar to Mark. We did our first public M&A transaction, acquiring a business called Capital Regional PLC. We did so at a 14% discount to their net asset value. It was a transaction that was strategically very aligned to our portfolio and our growth ambitions, but we were able to take out a ton of costs, and therefore it was a transaction that was going to be very earnings accretive. So we're very alive to be able to do other transactions similar to that provides that scale, better cost efficiency, very earnings accretive transactions, and we're confident we can really grow the business over the next sort of couple of years.
Thank you. Rob, longer term perspective on what a shareholder should expect from Supermarket Income REIT?
Yeah, look, so most recently or earlier this year, we made some strategic disposals and also a joint venture. So we've got proceeds from that to redeploy. So that's our near-term focus. We have 250 million to spend into some really attractive, exciting pipeline opportunities across the grocery space. So deploying that capital at levels which are accretive to our cost of debt and therefore support earnings, support the dividend. Our primary focus at the moment is demonstrating to the market that our current dividend yield is absolutely sustainable, but not only that we can grow it by certainly more than we've been able to in the last few years as we've been combating that higher cost of debt. So I guess echoing some of Alan's thoughts there around scale, we are focused on beyond that scaling the business further, but only where it is genuinely accretive to existing shareholders. That has to be the focus. We're not incentivized to scale for the sake of scale, but there are wider benefits, but it needs to come with the benefits to the existing shareholders through that accretion.
Thanks, Rob. And Mark, I know there's been significant change within the business, but what do you think shareholders can expect over the next few years?
Yeah, we've had a transformational year, clearly. I was sat on a panel literally 12 months ago, very similar to this, and I felt quite bullish on the day, and I said we might, try and double the size of the business over the next 12 months, and we've actually gone and done it. So I think the focus for management and the priorities that we have are very much around the acquisition of Assura, the integration, the delivery of the synergies, the huge cost benefits that transaction brings. We do need to delever. We were in a competitive situation with KKR that's well known. As a consequence of that, we took on additional bit of leverage to do the transaction, but we're very confident we can delever very quickly. And our number one priority is to dispose of some assets and ideally to participate in a new strategic joint venture. And when you have the likes of KKR, Stonepeak and others, these big global infrastructure funds looking at UK healthcare in the way that we've seen, we feel very confident that there's a wide and global appetite from investors to participate in the growth potential for UK healthcare real estate, and we're well placed to benefit from that and keep delivering for our shareholders, because that's why we're here ultimately. They've backed us in this transaction. We welcome a wide range of new investors that have come in to the company with the Assura merger, and we're very determined to keep delivering shareholder value, because that's what the most important priority is at all times.
Gentlemen, thank you for so much for your time today. It's similar with all these discussions that we learn so much more than we expect in such a short amount of time. So thank you to each of you. And we looked at the dividend growth, the dividend champions that we have in front of us. 29 years of dividend growth. We've looked at the importance of the earnings within the business and the scale and operational real estate. So there's been so much more to a real estate investment than you would imagine from a perspective of a retail operational shareholder, and the continued dividend strength from the businesses will be key. Thank you for joining us today, and we hope you found the discussion valuable and you now know much more about the value of UK REIT dividend champions in your portfolio. Please feel free to find out more on www.epra.com.